Greetings, Keith Prather here again with the NCM Marine Demand Outlook. Let me share my screen real fast. All right, here we go. So the NCM Marine Leading Index, and remember the leading index is giving us an idea of what demand should look like over the next 6 months. And right now, when we load the economic data into the index, and this has a number of different variables in it, we're getting a really strong signal for overall demand. And a lot of this is being driven by what is a really strong consumer environment and what we think is going to be some big infusions of cash over the next, easily over the next year. But if you look at the index itself, it really historically is kind of jumping up to a pretty high level. So demand should be good. We should see a lot of good disposable income. It was about 1.4% lower month over month. We got a little bit of that dip in November. Some of that could be seasonal. That's why we look at the year over year, and year over year, almost 20% higher is giving us a really good demand signal. Now, one quick point about this, even though we get a good demand signal, it doesn't always translate directly into sales. Sometimes other factors are in the way. We may have 9 or 10 metrics that look like they're conducive to sales, but we may have a couple that are holding consumers back from actually, hitting showroom floors and actually making purchases. So we've got to keep that in mind. But generally, when we look at the environment overall looks conducive and looks favorable for increases in sales. Now, the producer price index for boat building was still growing at about a 1.4% year over year rate. If I showed you what the actual index looked like, it would be a pretty strong growing index overall. The year over year percent change is going to feel a little bit weaker, and it is a little bit weaker than what we've seen over the last 5 or 6 years. Kind of coming out of the pandemic, a lot of people with a lot of disposable income and couldn't go out and do a lot of tight social types of gatherings, decided to do things outdoors. And so that's why we got a nice surge in, the producer price index and boat demand and, just general boating overall, seeing nice increases. So we're still getting this growth. If you look at it prior to about the 2019 period, still what we'd call underweight. It's still not growing at the rate that we would like to see it grow at. But again, you're still talking about a significant amount of volume of boats being sold nationwide, based on current trends. So a couple of things I wanted to talk about, and the first of all is this notion of the K-shaped recovery. And I've talked about it in several different videos. Hopefully you remember it. Hopefully now you're finding that that this is old hat for you. But there's a couple concepts I want to pick up and a brand new one that I want to really bring out. So remember the K-shaped recovery, that there's an upper band of the economy, households making 75,000 and more. They're actually doing very, very well. And the spending in this category has been tremendous. In Q4, we saw consumer spending driving about 80% of GDP. Normally is about 70%. So consumer spending is still very good. Stock market wealth growth in this area has been phenomenal. Wage growth is anywhere from 4 to 8%, which traditionally has been very strong. So there's still a tremendous amount of disposable income up here in this category. And that's why, marine sales, at least marine foot traffic, has been pretty good. Now, with the incoming Trump administration, we've seen consumer sentiment even jump further. And so with a little more certainty in the environment. So if we know that the regulatory environment's going to get easier, corporate profits ought to improve, that typically leads to better hiring, higher wages, more job security, and people who have been sitting on a lot of cash may decide to go out and put that cash to work. And that's when they come in and they look at some of these bigger ticket items like, boats, power sports, some of the things that we see throughout the NCM portfolio. But what's interesting about this also is that we think we're about to activate this bottom end, the 78 million households that are kind of in the bottom end of the income category. So those making $75,000 a year and less have been really under pressure from inflation. But as inflation cools, and as job openings and wage growth stays pretty strong, you have a nice gap in there between their income and what their expenses look like. And so with additional disposable income, once they pay down credit card debt and get themselves in a little better shape, then they can start going out and thinking about making purchases. So, used boats, especially in fishing and a little bit of leisure activity, I think you could see some improvements there. Personal watercraft, there's a smaller jet skis and devices like that or equipment like that. I think you're going to also see a nice little impact and a nice little input there. Again, as the 78 million households start to get activated, you're throwing just a smaller but an important percentage of buyers back onto showroom floors to accompany the ones that have been there for a while and the ones that we think will accelerate in this upper end of the income spectrum. So real disposable income, again, when we think about big ticket item purchases, this is the one factor that really seems to have the biggest impact on whether people are hitting showroom floors or not. And so this inflation adjusted personal income, disposable personal income is kind of what's left after we pay taxes and we do some of the essentials. Whatever's left over is discretionary and we spend it on whatever we want. So a lot of people will go take on additional debt and they'll take on big ticket purchase debt, to be able to accommodate their interests. So it's going to be growing at about 2.7% for 2024. Under the past Trump administration, it grew at about 3.1%. So we think we're going to still get that decent amount of growth. But for 2025, right now, the forecast is a little bit weak, 2.2%. I think we're going to end up bumping that up, especially if we see inflation standard control. And then for 2026, again, a little bit weaker at 2%. But I think those can be adjusted upwards. So, and overall, when we look at the economy overall, Q4 was coming in pretty good, 2.9%. We think it'll come in about 2.7. Last year it was about 2.5. So the economy still continues to hum along at a pretty stable rate. For this next year, we're still looking for growth of about 2.7% overall, should equal kind of what we had in 2024. And that's a little bit better than the historical average of about 2 to 2.1%. So you've got an economy that's still going to be growing a little bit faster than expected. More importantly, you've got a healthy consumer, fairly tame inflation. It creates a pretty good environment looking forward. And again, as we saw a little bit of a boost in sentiment, that helps. And then in some of the other videos, we're talking about the great wealth transfer. We know that there's somewhere between 53 and 83 trillion dollars that's going to transfer from the baby boomer generation to younger generations. And as they get this wealth, a lot of them will go out, and especially if they've got their current household income and their finances under control, they get this big boost in income. This big cash and wealth creation, and they'll take a portion of that and they'll go out and they'll do something frivolous. Well, we say frivolous. They'll go out and do something big that's kind of fun, and so that would really hit the power sports and marine sector. So anyway, that's what we have kind of going on for this month. Hope you enjoyed it and hope you have a good month ahead, and we'll see you next month. Okay, take care. Bye bye.